Let me ask you a direct question. You've worked hard. You've been disciplined. And today, your bank account shows over $50,000 in savings. You feel responsible. You feel secure. But here's something most banks don't take the time to explain clearly. Once your money is deposited into the banking system, it doesn't simply sit idle in a vault. It becomes a resource that the bank uses to fund its economic activities. And understanding this mechanism can completely change the way you manage your savings. Today, we're going to explain what really happens behind the scenes, how banks use deposits, why the interest rate spread exists, and most importantly, what you can actually do to make your money work more efficiently for you. Welcome to the channel. Here, we talk about personal finance in a simple, realistic way without unrealistic promises. Just the principles many investors wish they had understood sooner. Today's topic is surprisingly little known, even though it concerns almost everyone: what your bank actually does with your money. By the end of this video, you will understand how bank deposits actually work, why savings rates can vary significantly between institutions, and how to manage your savings wisely. Let's start with a very common misconception. Most people think of their savings account as a safe. The money goes in, stays there, and earns a little interest. In reality, it works differently. When you deposit money in a bank, that money becomes a claim you hold against the bank. In other words, the bank owes you that money and is committed to returning it when you need it. Meanwhile, the bank uses a large portion of these deposits to finance its activities: mortgages, business loans, consumer credit, and financial investments. This is what we call the modern banking system based on financial intermediation. Historically, banks were subject to a requirement called a reserve requirement, which mandated that they keep a portion of deposits in reserve. In the United States, the Federal Reserve reduced this ratio to 0 in 2020. But this doesn't mean that banks can lend without limit. They remain subject to other strict rules, including capital ratios and liquidity requirements. These rules determine how many loans a bank can make relative to its capital. So how do banks make money on deposits? The core of the banking business model lies in what is called the net interest margin. The bank collects deposits at a certain cost, for example, a savings rate, and uses these funds to make loans at a higher rate. Mortgages, car loans, personal loans, or credit cards can carry rates ranging from a few percent to over 20%, depending on the type of loan. However, it's important to understand that this rate is not the bank's profit. Banks have to cover many costs: loan losses, operating costs, funding, regulatory requirements, and capital. After these costs, the average net interest margin in the banking sector is often in the range of 2 to 3%. But even with this relatively modest margin, the volumes are enormous, making banking very profitable on a large scale. Now, why talk specifically about $50,000 in savings? It's not a magic number, but once you have tens of thousands of dollars, the difference between a low-yield savings account and a more competitive one becomes truly noticeable. Let's take a simple example. If you leave $50,000 in a savings account earning around 0.4% per year, you earn about $200 in interest. If the same amount is placed in a high-yield savings account offering, for example, 4.5%, the annual interest would be around $2,250. The difference is therefore more than $2,000 per year. This kind of difference isn't guaranteed over time, as interest rates fluctuate. But it clearly illustrates the potential cost of leaving your savings in a low-yield product. And this is where many people fall into a very common trap: financial inertia. Let's take a concrete example. Imagine someone we'll call David. David is 42 years old and works in IT. Over the years, he accumulated about $73,000 in savings in his traditional bank account. The account earned about 0.35% annual interest. That amounted to about $255 per year. During the same period, some FDIC-insured online savings accounts were offering rates closer to 4.5% to 5%. At 4.75%, David's $73,000 would have generated about $3,400 in interest in the first year. The difference is significant, but it doesn't mean the bank was doing anything wrong. It simply means David was using a financial product that wasn't optimized for his savings. After comparing the options, he moved some of his money to a higher-yielding savings account while keeping some in his primary bank for everyday expenses. The transfer took him less than an hour. This type of decision may seem simple, but many people never make it. Why? Primarily for 3 psychological reasons. The first is familiarity. We trust institutions we've known for a long time. The second is the perception of complexity. Opening a new account seems complicated. The third is the perception of risk. But there's an important point to know. In the United States, deposits in FDIC-insured banks are protected up to $250,000 per depositor per institution in the event of bank failure. This guarantee doesn't eliminate all financial risks, for example, inflation or interest rate fluctuations, but it protects capital against bank failure up to this limit. So how do you structure your savings intelligently? A simple approach is to organize your money by levels of liquidity. First level, the emergency fund, generally 3 to 6 months' worth of expenses, held in a liquid and secure savings account. Second level, short-term savings for projects in the coming years. Third level, money intended for long-term wealth building. For this third level, some investors choose diversified portfolios of ETFs or stock market indices. Historically, the S&P 500 index has generated an average return of around 10% per year before inflation over a very long period. But it is essential to understand that these returns are not guaranteed and that markets can experience sharp declines over several years. This is why investment horizon and risk tolerance are crucial. Finally, a good habit is to review your savings strategy at least once a year. Compare rates, check the allocation of your savings, and ensure that every dollar is invested in a product suited to your objective. Your bank is not your enemy. It is a business that provides essential services to the economy. But like any business, it operates according to a business model. Understanding this model simply allows you to make better decisions about your own money. Building lasting financial security rarely relies on one big, dramatic choice. It relies much more often on a series of simple decisions, repeated over the years. If this video has helped you see your savings in a new light, like and share it with someone who might benefit.